Hey guys, welcome to the show. We're doing a little different this week because Jerry's out of town and so am I. What do you got for us
All
this
right.
week, Jerry?
Take 17. 17 or 50.
Uh,
Pretty amazing tech stuff you got going on there, my friend. All right. Let me share my screen and we'll get it on. Okay. Can you see that?
yep.
All right, good. Weekly update show 11 July 2021. It definitely was a wild ride for the market this week. We finished the C fund. I did not update that. C fund was up 0.40%. S fund was down 0.42%. I fund was up 0.28 and F fund also up 0.28. Okay. So for the week, what we're going to talk about is I have a chart for how the week actually looked on the C fund. It's very messy, as our friend JC Peretz would say. It's a very messy looking week. Then we're going to take a look at the C fund Fibonacci targets and Elliott Wave projection. If you don't know about Fibonacci and Elliott Wave, I got the Fibonacci target link in the show notes, and we've talked a ton about Elliott Wave, and we'll continue to do that. So if you haven't seen it before, you'll definitely get the idea as we go forward. And then we're going to look at charts of the S and I fund Fibonacci targets. And the bonus chart this week, we got off of Bitcoin. It's a Snowflake is the name of the company. The ticker symbol is SNOW. It's a great example of a head and shoulders bottom pattern. And then we'll, of course, get into the 18-month weekly charts. Okay. So this is a 1 month where each tick on the chart is 30 minutes. So the whole chart is 1 month. Each tick is 30 minutes. So as we're looking at it, this was last week right here. Okay. So this section was last week. Pretty messy, to say the least. For the past week and a half, we ran up pretty much in a straight line. And then we had this week that was just really challenging. We had a big, let's see, let me erase this part. We had a pretty good gap down here and then recovered, and then a full out gap down right there. Recovered up, closed the gap, and then on Friday actually moved higher, which is fine. Ordinarily, you would expect to close the gap and then roll over, but we closed the gap and kept moving higher. We'll see. What's interesting about this is we got a really big overbought on relative strength back here at the end of the first week of July. And as we got this higher high, we got a lower high in relative strength. And then as we got this higher high, we're pretty much the same as what we were on the prior one for relative strength. So you really want to see relative strength go higher with each high, which kind of puts this a little bit suspect. But again, this is a 1 month chart where each tick is 30 minutes. So we can't trade on this. The only reason I'm showing it is because if you were looking at the market as you're walking, by the TV in the office or whatever, and wondering why it's up so far one day and down so far the next day and back up the next day, it's because it was. It was a crazy week. Okay. So C fund Fibonacci targets and Elliott Wave projections. Basically, I'm going to do this in two pieces. So this left side of the chart is Fibonacci projections. And then we're going to talk about Elliott Wave, and they sort of relate, but you kind of got to look at them independently. So right here is the coronavirus low, right? This was the top of the market, and the market rolled over, and on the S&P 500, we had about a 35% loss if you were in between this whole section right here. All right, so that was a pretty major decline. So if we do the Fibonacci retracement and extension from the top of the market here to the bottom here, okay, we can see that what we would expect to happen at some point, the market recovers, and in this case, we hit a low. The market retraced back up to the 38.2% retracement level, right? Came back down, hit the 23.6, came up, hit the 61.8, came down, got support there at the 50, and then kept going and got a little bit above the 100, right? So it got all the way back to where it was before. So the retracement levels is where you would expect, if the market was going to roll over, you would expect it to happen at one of those retracement levels. But once it blows through that retracement level, your target then is the next retracement level. Okay. So once you get past 100% retracement, then your targets become 1.618, 2.618 of this whole move. So the distance between here and here times 1.618 gets us to 4159.67. Okay. So all I did on stockcharts.com is go to the Fibonacci retracement tool, put the cursor here, pull it down to here, and it gives me all these retracement levels, and it projects up to the 161.8 extension. Let me do this. So the 161.8 extension was about 4160. So in this area right here, we played around in there for several months as the market was trying to break through that Fibonacci extension level. Now it looks like, as of this week, we have pretty much broken through that extension level. So in terms of Fibonacci, the next target is 5340. That's 2.618 times this whole move is 5340. So that would be the next Fibonacci target that we would expect the market to get to before it starts pulling back. Okay. That's Fibonacci on its own. So if you're using Fibonacci, that's what you're looking at. The next piece is Elliott Wave. So we talked about this count months ago. I think it was actually back in here when I first put up this chart, because this move right here was the first major correction off this low. Okay. And if we do the wave count, you got 1, 2, 3, 4, 5, which gives us the 1. And then you got A, B, C, which gives us the 2. And then this is 3. And then somewhere in here we get 4. And then we get a 5. That's the idea. That's how we expect the count to progress.
Now, Jerry, do we expect that those two indicators to, normally go together, the Elliott Wave and the Fibonacci?
They don't have to go together. When they do, it becomes a much more
a stronger, probably
significant point, stronger point of either resistance or support. But they don't have to go together. That's why I'm kind of presenting them sort of independently. In this case, actually, we hit, the 100% retracement level. We got a little bit above it on the 5, but we had the 1, 2, 3, 4, 5 that got us to the 100% retracement level, and then we went sideways. So it worked. They both pretty much were in line on leg 1, right? Leg 1 of 5, which as we get to. But there's a couple of possibilities here. So let's see. Let me just explain the rules. The Elliott Wave rules are very simple. Wave 3, right? So here's wave 1, here's wave 2. Wave 3 cannot be the shortest impulse wave, meaning it can't be the shortest wave that's going in a positive direction. So right now, wave 1 in terms of points, dollar values, whatever points, wave 1 is longer than wave 3 right now. So if wave 4 was to start to happen here, since wave 3 is shorter, not in time, but in points, is shorter than wave 1, that means that wave 5 would have to be shorter than wave 3, because wave 3 can't be the shortest. So there's only a couple of possibilities here in terms of Elliott wave. And I'm not, these are all indicators or theories. I mean, none of it is guaranteed, but in terms of Elliott wave, here's the possibilities. If leg 3, this part right here, is shorter than leg 1, then leg 5 has to be shorter than leg 3. So that gives us a cap on the highest that the whole 1, 2, 3, 4, 5 series could go. So we got 1, ABC is 2, and let's say we're in 3 right here, which is shorter than wave 1, and then we start getting a 4 like that. That means wave 5 can't go longer in terms of points than wave 3, which would put us up here around that 4,600 level. That's one possibility. The other possibility is wave 3 is the same length as wave 1. If wave 3 ends up being the same length as wave 1, then we do get, that is 4,600. That means wave 3 gets to 4,600. Then we get a 4 and then a 5. The other possibility is wave 3 is longer than wave 1. And if wave 3 is longer than wave 1, the most likely wave 3 extension relative to wave 1 is 1.618 extension. So this is 1,400 points. From 3,600 to 2,200, it's 1,400 points. If you multiply 1,400 by 1.618, and you add that to 3,200, you get 5,465. So this is where we would be at the end of leg 3. Then we would get a 1, 2, 3, 4, 1, 2, 3, which would be the 4, and then we start the 5. So there are some possibilities in this that the whole 5 wave could end up here at 5,340, somewhere between 5,340 and 5,465. It's definitely possible. It's also possible that wave 3 continues, gets up here, does a wave 4, and wave 5 can keep on going. The only one that really limits the how far leg 5 can go is if leg 3 finishes shorter than leg 1. I know there's a lot of ifs and possibilities in here, but that's just the way it works. There's really only 3 possibilities in terms of Elliott wave, and the Fibonacci projections are just math. That's just where they are. So you can see that we got a lot of resistance here at this 161.8 level, and now we're above it. So in terms of Fibonacci, one way or another, we get back up here somewhere around the 5,340 number in terms of Fibonacci. In terms of Elliott wave, the wave will play out the way it does, but this is a pretty clear 1, 2, 3. At some point, we're going to get a 4, and then we're going to get a 5. So the bottom line for all this is we're going to get a 4 in here somewhere, and it could be relatively deep, but the count does not support that this 4 is going to be a big crash. Does that make sense?
Absolutely.
Okay. All right. Last thing about this. If leg 3 is greater than leg 1, right? So if leg 3 ends up here greater than leg 1, and it gets up here to the 1.618 extension level, that's a 25% move higher from where we are right now. And it's absolutely a possibility. So just keep that in mind. It's absolutely a possibility. Okay. Hopefully that makes sense with that. S&I fund Fibonacci targets. The Elliott Wave didn't work as well on the S&I fund, so I just kind of focused on the Fibonacci extension levels. So same thing. This was the top before COVID. This is the bottom at COVID. These were the retracement levels. We hit 100% up here, had the correction sideways just like we did on the C fund. Got up to the 161.8 level and then rode above that level for a while. And we're actually still above it. We're still trying to figure out how to break out of there. And it's been, the majority of 2021, we've been in this sideways channel just barely above that 161.8 level. The next target is 2732. So if we can get out of this channel, the next target is up here somewhere. Generally speaking, you got a big move higher and a consolidation. It can consolidate for a while. It has been consolidating for a while. But when this is a one leg. It's a 1, 2, 3, 4, 5. That's fine. But at the end of the day, this is a 1. It's very unlikely that it goes sideways and then rolls over. It's just not the way it works. This is going to end up being a 1 at some point, a 2, and then a 3, 4, 5. The only way that it doesn't do that is we draw this bottom channel line. I mean, if we get a close somewhere significantly below 2000, then it's wrong. Then this Elliott Wave pattern is wrong. But it's very unlikely that we're going to get this huge consolidation and then it rolls over. It always explodes higher out of those consolidations. It's just a matter of not getting eaten by the in and outs as you get these moves, because these moves down are not insignificant. Okay. iFund, also very similar. It's a little bit different in terms of Elliott Wave. I actually kind of think this is a 1, A, B, C, 2, and we're in the 3, just like we are on the C fund. This drop that we've had here in the last couple of weeks or so could be a 4, which would be leading us, actually, which would be kind of interesting if it turned out to be that. So we'll keep an eye on the iFund. It's not performing well relative to the C right now anyway. So I don't know too many people that are in the iFund, but in terms of the chart, it's pretty interesting. We just hit just barely below that 161.8 retracement level. So that might be good enough for a 4. And then once we break back above that, we're in the 5 and we hit up here at the 2.618. Sorry, I have my decimal in the wrong place. What you do is multiply by 2.618, but that is 261.8% of the move. So we could end up here on the iFund at the top of the 5th. 1, 2, 3, 4, 5. That's a definite possibility. We will see how it turns out. Okay. Snow. So Snow is the ticker symbol. The company is called Snowflake. It's a data warehouse company that sits on top of Amazon Web Service or Microsoft Azure cloud infrastructure. It's a cloud-based service, right? So companies don't have to manage the setup, maintenance, and support of in-house servers. But what makes Snowflake really cool is it allows storage and computer to scale independently. So companies pay a separate rate for storage. They pay a storage rate separate from the data processing rate rather than have them both bundled together. I'm going to put a link up to Snowflake. If you're interested, check it out. It looks like a really cool company in terms of what the company does and the fundamentals. But as you know, we do technical analysis here, which is how it got on my radar. So the way it got on my radar was because Friday, it went up 7.67%. And it came out of this left shoulder, head, right shoulder, Head and Shoulders consolidation. This was back here was the IPO. So the company went public back here September of last year. Has this huge run up, comes back down. You got a big volume spike here, which is close to the bottom. Then the volume recedes. You got really low volume all the way along. You get the good Head and Shoulders pattern. I can get rid of all this stuff here. Then once we got back above the 50-day moving average line, the blue line, we stayed there and got support at the 50-day every time it tested it. And then broke out huge on Friday on really big volume versus the several days before it. Not compared to these volumes, but compared to volume in here, it was really big. So from a technical perspective, Snowflake looks like a great buy. Seeing as how this was, let's see, 425, 430 is the high, the all-time high. We are right back where we were, let's see, 250 basically right here was the IPO right there. It opened here, shot up to here on the day and came back down. So if you bought it on Friday morning or Thursday of this week, you basically would have gotten the same price that people got in here at the IPO. But now if you buy it now, you're looking at it coming off a really good Head and Shoulders bottom pattern. So again, the only reason we put up these isn't because we're necessarily buying them or selling them. It's just an example of a really good chart pattern. And in this case, you got both the Head and Shoulders bottom pattern and support at the moving average lines and a huge breakout on big volume. So a lot of things to point out. TSP charts. So we're going to stick with the 18-month weekly charts. So how do we look on the 18-month weekly? C fund, while it had quite a week, as you can see right here. Oh, I can't zoom in. As you can see right here, we had a pretty good reversal. It was a very shaky week from my perspective because the intraday low got below last week's open, so it was kind of a problem for me. But by the close on Friday, it had made it a new high, just barely, but made a new high. I'm a little bit concerned with continued new highs for a bunch of different reasons, but a couple of the ones that stick out on the chart, we've had 3 weeks of increasing higher price on decreasing volume every week, right? Generally not what you want to see. You get the slow stochastic has turned higher. It doesn't really have much higher to go. It's at 99.13. But the MACD hasn't really moved. The MACD histogram hasn't moved. And the Silver Cross is continuing down. So the C fund, it's hard to argue the price. We did just break out of a pretty much of a sideways consolidation, and we had the breakout here, and the breakout continued this week. So in terms of price, it's definitely moving higher. But the underlying, what's underlying in the S&P 500 is really not looking good. There's another chart that I didn't put up, but it's called breadth. What's actually happening underneath is, even though the price of the index is making new highs, the number of companies that are making new highs is decreasing. So the index new highs are being driven by fewer companies, and it's not a good foundation to have continue having more highs. And you'll see it in the Silver Cross Index. So when the Silver Cross Index starts turning and turns back up, it means that there are more companies whose 20-day moving average is above its 50-day moving average. Right now, we're getting fewer companies whose 20-day is above the 50-day. So how does the number of companies that are moving higher is decreasing while the overall index price is increasing, right? It's a big divergence. It's definitely something to pay attention to. S fund looked like we had a breakout going. Unfortunately, it rolled over. It didn't completely collapse. It got support at the 10-week moving average line and reversed back up and closed, fractionally down, less than half a point down for the week. But it's kind of back in that trading range. So as long as it stays above the 10-week moving average, it's in pretty good shape. If it closes below it, I would be pretty concerned. The slow stochastic is above 80. That's not bad, but MACD has been trending down here for quite a while, and RSI still, you get the high point of the RSI is back here at the top, and it's been trending down ever since. So price has been mostly flat. RSI is trending down. MACD is trending down. We're back in a holding pattern on the S fund. It's not horrible. It's consolidating, right? It's doing this really flat consolidation. But again, these moves down are not, and up, are not inconsequential. They don't look like they're all that compared to this big move. But on a percentage basis, when you're looking at your account every day, these moves are pretty big. iFund really not looking good. We had this week that collapsed and closed just barely below its 10-week moving average line. And for the past 1, 2, 3 weeks, we've been below this high and are just barely struggling to stay at that 10-week moving average line. Slow stochastic has definitely turned over. MACD crossed lower. Relative strength is trending down. So the iFund is not looking good. It could turn around next week, but on a weekly basis right now, it's definitely not looking good. F fund has been doing really well since it bottomed out in March. So you get the bottom of the relative strength down here in March. You get the MACD crossed over here in May to the upside. You get the slow stochastic bottomed and crossed up in March also. Once we got above the 10-week moving average line, we found support at it all the way until this week, and we broke above the 50-week moving average, which is great. So if all goes well, the 50-week, the 10-week crosses up through the 50-week, and it just provides much more support for prices to continue higher. So the F fund, we've been talking about it. It's kind of strange because what's driving the F fund is interest rates, and that's connected to the hip with inflation. And so the idea in the media is that inflation is coming roaring back and it's going to be this giant problem. But inflation means interest rates go up. If interest rates go up, then the price of bonds goes down. And the F fund is a chart of the price of bonds. So the next chart I'm going to actually do is going to show both the F fund, which is the chart of the F fund, but the chart of the price of bonds, and the yield, which is interest rates. So this is a 15-year weekly chart. Okay, this is the F fund. It's the price of the F fund, which is the price of the aggregate bond index. The black line is the price of the yield, the 10-year treasury yield. Okay, so it's interest rates. It's the yield that you get on a 10-year treasury note. When the yield is going down, the price of the bond is going up. The F fund doesn't track the 10-year, doesn't track the inverse of the 10-year, so it's not exact, but you can see that it's pretty close to a mirror image. It's not exact, but it's close. So as yields come down, price goes up. What's interesting, the most important takeaway from this is you got a whole bunch of support at that, whatever this is, 72.50 or something. A whole bunch of support at that level. We broke below it right here. Okay. So prices had been, yields coming down, prices are going up. That's fine. But this was a big break because this is a significant support resistance line, right? It's been in place since 2012. We broke below it. Prices continued higher. As we put a low in, and the yield started coming back up, and the F fund prices started coming down, right? We got above that support resistance level and then rolled over, and now we checked below it in the last 2 weeks, which is why we have this big, I shouldn't say 2 weeks, it's actually been the last, since March. So here's the bottom line. It looks like support did not hold. And if that turns out to be correct, and the yield continues down and tests the prior bottom, then what happens? The F1 price keeps going higher. It looks like that's what's happening. If the yield turns around and starts going up and finds support there and keeps going higher, the F fund will start coming down. Does that make sense?
It does to me. Hopefully it does to everybody watching.
So you're the only one that can answer my question, so that's good. All right.
I didn't know if you were asking the studio audience.
Yeah, I don't have a studio audience here. I'd be talking to the seagulls. Okay. It might have been a pretty technical one, but yeah. Anybody get questions?
All right. You're going to take us back to your camera?
Are you pulling us out to back to us? Oh, I forgot. I have to do that. Okay. It'll take us a minute to
we'll get the kinks working.
Learn how to do this. Stop sharing. There we go.
There he is.
I'm back.
All right. Well, we'll get better at this as we do it more.
It was a good test, right?
Yeah.
Yeah, definitely give us some comments, some feedback, because the big picture thing of this, yes, I'm on vacation in a different place than Conan is, but what we're ultimately wanting to do is pull people in to do interviews and things, and the only way we can really do that is to get really good at this setup that we're working on right now. So yeah, this is kind of a test.
Zoom just doesn't work well enough for what we're trying to do. No. So we're using something else. All right. Well, hopefully you guys enjoyed the show. If you're wondering why I'm stuttering, it's because I have an echo. We couldn't fix it. So I didn't talk a lot. All right. See you guys next week.
All right. Have a good week.